Hi, everyone. Welcome to Topline. It's your host, Sam Jacobs, with my co-hosts, Asad Zaman and AJ Bruno. We're here to talk about the most important insights in go-to-market. And I have a little bit of a cold, so I might be doing marginally less talking today. But I do love the sound of my own voice. So that is
I love how Sam just paused in the middle. He's like, "No, that doesn't sound right. That's
Doesn't
not
sound
me."
right. I love talking.
Welcome to Topline, the podcast for the best founders, operators, and investors in B2B tech. Every week, AJ Bruno, Asad Zaman, and me, Sam Jacobs, will break down what's important for you to know to be the most well-informed professionals in the market.
What do the revenue leaders at Google, 3M, IBM, Shopify, Square, and Cisco have in common? Their teams all use SalesLoft to hit their number. SalesLoft is the only platform that's designed for the way revenue teams work every day, so sellers can prioritize and take the right actions to get more deals done, from prospecting and deal management to coaching and forecasting. No more guesswork, no more wasted time on non-selling activities. Follow SalesLoft on LinkedIn to learn more.
Yeah.
How's everybody doing?
Good. CEOs aren't allowed to be sick, Sam. That's not a thing.
I know. We're also not allowed to go on vacation. There's no vacation. It's not a thing anymore.
There's no joy in being a CEO.
Oh, for God's sake. There is no vacation, though. I do agree with that. Like, you have to be on pretty much all the time.
It doesn't, yeah. And just there's stuff that happens, and then people are like, do you have a few minutes today? And you're like,
Yeah.
Okay.
Yeah.
And so then you complain about it, but then you're like, well, the day that I don't get any messages at all, well, that will be a very sad day. So I'd rather complain about getting all the messages than getting no messages at all.
Sam, I have a fix for this.
What's that?
There's this handy dandy mark unread button at the top of Slack. You just click it, and then magic happens.
Really?
And you're done.
That's probably a good idea. I mean, yeah, it's just you never feel like you completely. I mean, but I guess maybe you did on your camper trip through the national parks. What have you been?
No.
Have you had a period where you just turned off your phone and said nope?
No, I haven't had that since the day I started my first day of work, February 7th, 2008.
You remember the day of your first job?
Of course. Do you not remember your first job?
No, I don't even know what month it was.
I have a little secret about it wasn't my first day, but it was my first week. So in 2007, I was expected to do 60 cold calls a day. And it was like, I've talked a little bit about Meltwater's culture, and just like I had to be ass in seat at 8 a.m. and I couldn't leave until 6 p.m. And you couldn't prospect. You couldn't actually do work at work. You had to only make cold calls at work.
Oh.
So you had to do prospect on your own time.
Where were you living?
At my house at my parents' house in Pottstown, Pennsylvania. And I would drive 40 minutes to the Exton train station, take the hour train in. So I would get in and work at 8 a.m. So I left at 6:30 a.m. and I'd get back around 8:30 p.m. And then I'd go to sleep and do it all over again. And my one joy at that time was watching an episode of Friends. So I would watch an episode of Friends, and then I'd go to bed, and that was it.
You've been with Anne since high school, though, so you were in a committed relationship at this time?
Yeah, but she was doing a year of service in New York, so we weren't married at this point. So I was living at my parents', getting my soul sucked out of me. And the soul sucking was like, I was deathly afraid of cold calls at this time.
Oh, really?
Oh yeah, deathly afraid of them at that time. And so one day I came in my first week, and I was walking. I remember walking by the McDonald's and being like, I don't want to do this today. How can I not do this? And I was like, you know what? I will just unplug the internet and not have VoIP. And so that's what I did. I walked in, I was the first one in the office, and I just pulled it out ever so slightly so that it would confuse the leaders and the managers and be like, uh-oh, I guess we can't work today. And guess what, guys? Yeah, I'm dead serious.
What?
No, it worked for 10 minutes and then they figured it out. And then I had to make cold calls.
And they had no security camera to show you futzing with the wires.
No. Do you think they'd fire me for that? Probably. But
Yeah,
They might.
fair.
Yes.
That's a very fireable offense for
that feels
a
like a
young
very
cold
clear,
caller.
fireable offense. You're trying to disrupt the economic activity of your company.
For everyone.
that was
Your honesty.
Yeah, I mean, this was 20 years ago. I think my honesty is that everyone on this that's listening to this conversation has done something like that, including you two. You've done something to this level.
My brother
I've definitely done a lot of really bad things. That's for sure.
My brother tried to burn the school down. So yeah, it happens. Yeah.
Okay. How do we go? Like, that's not even equatable. How do we go from unplugging the internet to burning the school down?
I think it's the same spectrum. If you just extrapolate out, it starts there and it ends there.
Man, oh my goodness, goody two shoes. You guys are both such goody two shoes.
Yeah. Okay, should we jump in?
Let's jump in.
Okay, so we've got a couple of really interesting topics to talk about. The first one is we're going to talk about growth versus free cash flow margin and how the premium on growth over free cash flow margin might evolve as rate cuts begin. So a few episodes ago, we shared some data from Redpoint Ventures around this. And essentially, venture capitalists, the data was very VC specific, obviously because it came from Redpoint, and venture capitalists always place a premium on growth because of the unique nature of tech companies. They have this unique ability to rapidly scale, they have recurring revenue, and they have high gross margins. And so the idea is that because of that, you can focus on growth for a certain period of time, capture market share, and then change your business model to become a cash generating machine. Obviously, most don't achieve this. Those who do become very profitable, Salesforce being a prime example. So their data showed that in June 2020, during the peak of COVID, the premium on growth over free cash flow margin had dropped to 2.2x. Then by 2021, peak ZIRP, exuberance, high demand for tech, it reached 11.6x in favor of growth. Inflation came, interest rates went up, the cost of capital went up, created a disincentive for investment. It reduced growth, cooled the economy down, and this rate dropped down to 2.9x, stabilized there for 8 quarters leading up to Feb 2024, and it's roughly in the same range right now. As of September, interest rates are going to start coming down. And so the cost of capital will get cheaper and this premium is going to evolve. So Sam, you coined the term PEG, profitable efficient growth, when tech was going through a recession. And as the market evolves, we're curious to hear how your thinking around this is going to evolve. Now, obviously, for some companies, it's very simple, right? Profitable, efficient growth for a bootstrap company or PE-owned business. I think it's very easy to understand what that means. But for a VC-funded business that does focus on growth over free cash flow margin early on, what does PEG mean? And how do you see that evolving as we go into this rate cut environment?
Well, I think it's a great question. I think, understandably, if you try to interpret my perspective over the last year or so, you might assume that PEG, profitable, efficient growth. By the way, it's fascinating that this has taken a little bit of hold. I didn't really realize that I'd coined it because other people have like different variations on it, but also PEG stands for private equity group in a different universe of lower middle market private equity. But the point is, I think
you didn't know when you were writing that I might be coming up with a term that really holds on. You never know these things when you do it. Yeah.
Yak. I didn't come up with growth at any cost. I really got that from Jocko. But I will say that if you assume profitable, efficient growth means cash flow positive every period and not growing, then you are misunderstanding what I'm getting at. What I'm talking about is not growing. What I'm talking about is growing efficiently. And I think there's room for efficiency, whether you're venture-backed, private equity-backed, or bootstrapped. I think that's the point that I would underscore more than simply the point of profitability. Mm-hmm. It's true that in a world to the point that you're referencing, Asad, where growth on the margin is worth 25% of what it was worth 2 years ago, that it makes sense to focus on profitability. But even today, growth is worth 3 times what cash flow generation in this period is worth. And so PEG doesn't necessarily refer to not growing or being cash flow positive. You can be burning capital and be a profitable, efficient growth business. It comes back to the same thing we've been talking about forever, which is, I talked about it last week, Weston Gaddy, Mark Roberge talks about reading the organic tea leaves of the business. Profitable, efficient growth means that the business is indicating to you that it is investable.
Mm-hmm.
And you posted Cassie Young wrote an article on LinkedIn talking about what did she call it? CAC allowability. I like
tolerability more.
We talked about tolerability last week, but both of those are mechanisms to indicate that, hey, there's a threshold at which we believe there's an appropriate customer acquisition cost relative to our payback period and our lifetime value, and we're going to be within that threshold. If you're investing against growth in that dimension, then by definition you are, well, I don't know about definition, but you are embodying the principles of profitable, efficient growth. So I would just underscore what I'm saying again. I'm not advocating for bootstrapping versus venture capital versus private equity. What I'm advocating for is the smart, intelligent investment of capital, of precious capital that your company has on the balance sheet against a business that's telling you it wants to grow. That's what I'm advocating for. I will also say, only to underscore your point, because right now it's 2.9, so let's say 3 to 1 rate, which for those listening, every dollar of growth is still worth 3 times that of a dollar of profitability. And that is again why I think Bessemer sort of reacted to this concept of the rule of 40, rule of 50, because the problem with rule of 40, rule of 50, rule of 60, whatever, is that it weights profitability and growth the same. And Bessemer's point is, no, they're not the same. And I can, here's a real world example. I was looking at a confidential information memorandum for a business that's an incredibly impressive business. It's doing about 200 million in revenue, doing about 100 million in EBITDA. But it's only been growing 10% a year, but it has, as you can tell by those numbers, 50% EBITDA margins. So that is a quote unquote rule of 60 business. That's a quote unquote rule of 60 business. But the 60 is comprised of 50% profitability and 10% growth. Well, that business at 200 million revenue is worth just over $1 billion in enterprise value, 6 times multiple, and only, really only 10 times EBITDA. You would think it would be worth much more than that, given those amazing profitability thresholds. That business also had something like 20, 25, 30 to 1 LTV to CAC. Again, what that means, when it's that high, the business is almost aching for you to try to get it to grow faster. And there's something about the management in that particular instance. I can't comment on. I don't know the people, but that is resistant to making that investment. Maybe they feel like that's not the right path for that particular asset. But I thought that was really interesting, and that's data from last couple of months basically, and it only underscores your point that again, it's great to be profitable, and it's particularly great to be profitable if you're not sure how to deploy your capital or how to grow. You might have great, because the other part of it, again, Cassie's post makes this point, is that you might have great unit economics, but that still might not be, if you're not measuring it accurately enough or precisely enough, it might not tell you enough about where to invest. That's sometimes been true for Pavilion. We've often had 4 or 5 to 1 LTV to CAC. We have really good unit economics, but that doesn't necessarily indicate where to invest. And again, that's why it's about CAC tolerability. You actually, and we talked about this last week when we were talking about market share, and AJ was talking about what is the crossing the chasm of like trying to get to the point where your market share begins to create profitability. But I would say that one of the lessons is like LTV to CAC is great, your unit economics are great. Sometimes that doesn't tell you what to do next, but at least it tells you maybe there's something to try, which in a way means that you're going to take down your unit economics as you look for opportunities to grow, which is exactly why she talks about allowability, or as you say, tolerability, because it's how much can we depreciate the existing unit economics in search of the growth channels. So that's all a long answer to your question.
Interesting point.
Yeah.
Because it can tell you what problems you have. So when things are not working well, it's kind of an interesting compass to be like, here's where you should think about focusing on. It doesn't tell you where to go next. And that's like vision. And so many companies, I was reading this post that had a term called the platform chasm, where a lot of companies, to become their fullest version, have to eventually become a platform, add more products in, and evolve into a platform. And how most companies fail crossing that chasm. Your unit economics won't tell you what moves to make there. That's the vision. That's why I guess tech favors founders so much more than hired gun CEOs. So AJ.
I guess the only other thing I'd add to that, and I of course want to hear what AJ says, but that's I would imagine it's particularly acute for bootstrapped organic growth businesses, because if you're not exactly, I mean, Pavilion again being somewhat of an example, right? Like most of our growth comes from word of mouth. Most of our growth comes from organic social, not paid social. Okay, so if you wanted to grow, what do you do next? It's not quite clear. Do more organic word of mouth. You're like, okay, how do I get, I mean, I guess you can give people microphones, right? You can make the referral engine easier and easier to optimize. You can put referrals everywhere, but it's not so easy when you don't have, it would be one thing if you're like on paid ads, I have 5-to-1 LTV to CAC, and on paid SEO, and effectively like I have 3-to-1. So okay, I'm going to spend more on paid ads and less on SEO, or I'm going to spend more on trade shows and less on paid ads. But if you're not doing any of those things, it's really not that obvious to say, how do we grow if most of your growth is happening organically anyway?
Well, I guess that's the point, though. It depends is the answer. And we all see different businesses of different sizes doing different things. By the way, before I jump into some examples, I got a ding earlier. That was me. If you all heard it, it's AJ. AJ's always the problem for not.
We appreciate your accountability.
But,
a good leader.
Well, the only reason I'm being accountable to it was because it was Wyndham Hudson, our chief product officer, starting
CPO. Shouted out last week in Wins of the Week.
He literally sent me a text. The text said, "Thanks for the shout out on Topline." So
this is all getting very meta.
It's very, very meta. Well, Sam, you watch basketball, right? I know how much you love Ohio State.
I do not love Ohio State. I wish them ill.
That was the most offensive statement I could possibly have just given Sam right now, by the way, for all you listeners. Yes,
I do watch basketball,
Sam is
though.
a Michigan alum. You did go to U of M, right? Oh no, you didn't.
No, I went to UVA,
Michigan.
but my grandparents, my cousins, my whole family's from Detroit.
Okay, so this is very distant.
Your whole family is from Detroit?
Yeah. My mom and dad are from Detroit. Their parents are from Detroit.
So you guys saw the rise and fall of Detroit then as a family?
They did, yeah. My grandfather was in the steel industry. My grandparents on my mom's side actually ran a bridal atelier.
We should do a whole episode on that. These backgrounds.
Today's bride. Anyway, go ahead.
My point being is that during college basketball season, like when it gets to the end of the season, do you always see these like blind resumes that pop up where like this team went 26-3 and here's what their record was against the top tier and should they be in the tournament? Sam, you know what I'm talking about.
Yeah, of course. Bubble teams and trying to figure out who belongs.
Yeah, Asad doesn't have a clue what I'm talking about right now, but it's okay.
March Madness
and bubble teams. And I feel like you could do the same thing with startups in terms of, are they fundable or are they not fundable? You have a lot of other leverage points that we're not talking about. There's, because I'm an angel investor, I get to see a broad swath of different types of companies. And, a company last year that I was looking at to invest in was growing pretty nicely. I think it was growing from $12 to $20 million year over year. But they had $5 million in debt, and they were running low on cash. And so the term sheet that we ended up investing in had 2x participation at a 65 or 70 million, I can't remember, doesn't matter, pre-money valuation. And so when you do the math on that, it ultimately came out that it was just different fundable, different dynamics, different different mechanics of a venture-backed company that were interesting to invest in. And point being is that investors, depending on size and scale, are going to look at the businesses in relatively different ways. And so this idea of profit-efficient growth is the right thing, because when you focus on that, the symptom that you're going to see is these KPIs that are going to make you fundable, but you're not going to, no company out there is perfect. And so you're not going to have these perfect investable moments, because Sam, you're right. Your business is word of mouth, organic. If you were to say like 2 years ago, as you hit an inflection point on that and someone looked at the business, you could just like cover and say, hey, our pipeline is growing X over Y. And an investor might not dig into the reasons why. It's just like, okay, great, this is a healthy, fundable business, but that there's some level of ceiling to that. And then what? And so like when you're thinking about your business and you're thinking about the future, it's really important to futurescape these pieces of it. Of, okay, what happens once I hit that ceiling of organic social? Then what do we do from there? And to have these conversations with your management teams.
I think, but I like to think of the fact that a business has a compass within it. But the hard part is we don't really know how to set up that compass, because the inputs are all the various KPIs, but you have to weight them, and the weightage is different based on stage of business. And in essence, this is what product market fit should be about, right? Like this weighted score based on all these different metrics, telling you how you're doing, pointing you in various directions, giving you things to think about, opportunities, priorities, problems, etc. But it's really hard to know how to weight them, and I think that's the challenge with it. AJ, to what you're saying, that company raised was it a seed round or a Series A?
No, this was a, if I ever remember correctly, it was a Series B extension.
Series B extension. And were you like a past investor, or were you new in this?
Past investor, but I was an LP in a fund that just happened to there was some level of pro rata right participation. So pro rata, for those that are uninformed, allow a fund or an investor to participate to hold their equity holdings, which in a lot of cases is a really important term. Sometimes I would say it's the most important term for investors, especially seed investors, is to hold their equity position, because getting diluted down with terms that aren't pari passu means in like the same level. So if I'm a Series B investor and I'm a seed, like trumping as a preferred is not ideal. So you want that ability to invest in the same terms that your later stage is a really important term. And so for all founders out there, something that I advise early stage and seed to think about is like, what does that mean for the future rounds for your investors, and why are they asking for pro rata or super pro rata rights, which means that they could go above and beyond? Like, why would they do that? And it's good for the investor, and in a lot of times it's good for the founder as well to have those type of rights. I know we're getting a little bit off topic, but I think these are important terms for our audience to understand.
Yeah. So going back to what we were discussing, these marks of like growth versus free cash flow margin, it's going to change, right? What the market prioritizes in terms of growth versus FCF margin will evolve as interest rates come down. So AJ, how does this work? Like, you're a traditional venture funded business doing well, great investors. Are they coming to you and saying, our view on the future is this, and so here's a new set of things that we need you to optimize for based on where we're going? Or does it play out more organically? Like, how does this actually work for a business like yours?
I mean, no, they're not coming to us. And the reason for that is quite simple, is that we are meeting expectations, we're exceeding expectations this year, but I don't think we've completely cracked it ourselves, so that our growth this year, while we pulled burn down, isn't going to be in that traditional Bessemer triple, double just yet. And until we can show signals that we're going to hit that inflection point, the appetite for investing further from our balance sheet into the business won't won't be there at the growth equity. So meaning preserve your balance sheet until you really feel like you've figured it out, and then you can unlock those growth mechanics work well that we were talking about. If you feel like for every dollar you're putting into the business, you're getting $1.50 out of the business, and your NRR numbers are quite high. That's when there's an excitement, and that's when you become a fundable business. So, Sam's talked about fundability of his own business. We're not raising, and nor do we have any plans to raise, but I wouldn't consider us a fundable business today for that reason, is because of our opportunity is huge. And me as a founder, I am as optimistic as I ever have been about the business, both because our short-term numbers are there and we're hitting expectations, but also we just came off of an offsite last week where the long-term and aspirational alignment throughout the entire organization is fully there. And that's what's most exciting. And so when you have the short term and the long term as a founder, you feel a sense of, okay, I'm doing one of the jobs that I have, which is bringing alignment and having both operational rigor and cadence in the business in the short term, but getting the alignment to the team to the long term. It's a constant motion and a constant battle, but something that I feel I could grade us high marks today, but I would not say at the board level or investor level it gets us anywhere than where we already are.
I would say that I think we're touching on something quite important, even though we tend to talk about similar themes. But when I am thinking about what AJ's saying, which is the fundamental point about fundability, and really the point about unit economics, is that, which is the point that I think both of us are making, is that you know what to do with a dollar. You know where to put it. And for me, what comes up is that is why Ryan Milligan, or people like Ryan Milligan, this is why the team is so important. Because you don't actually give $1 to paid ads. What you do is you give $1 to a person that runs a department that makes an investment in paid ads.
Yeah.
And it is part of what, product market fit is. I've got a problem is really about the development of the product that you've built and figuring out whether customers will renew. But go to market fit is, have we built a repeatable process? And a repeatable process, as Robert said on sales acceleration formula, is about hiring the same kind of people, giving them the same kind of training, giving them the same kind of leads, and having them run the same sales process to deliver the same kind of output. I guess the point is, you really have to have great people, because you need to rely on them to build that repeatability. You need to rely on them to hire the right people under them. You need to rely on them to train the salespeople in the right way. If you're doing B2B sales and you're doing any kind of sales organization, to the point of your whole job, Asad, you need to hire the right people, because if you're hiring wildly divergent types of people and you're giving them wildly different types of leads, by definition, you will not have any predictability. Some months you'll have a great month. Some months you won't have a great month. It won't have any relationship to what you think your pipeline is, because you don't have a tight enough definition around your ICP. That alignment that the founder drives has to flow through to the leaders of each department. And those people have to be really, really good and disciplined, frankly, in a way oftentimes that we as founders are not disciplined.
Yeah, 100%.
That's the gap. The gap is can I find somebody that's highly operational and process driven, that understands that their job isn't just to do the same thing over and over, and it's not even to hit the number. What their job to do is to uncover veins of investment for the organization as a whole. Can they surface, okay, we've got a playbook that hires SDRs. Those SDRs have predictability. We know that if we spend $2 on an SDR, we get $3.50 back in 18 months. Good. That works. Now let's look for other veins of predictability. Again, it's why I tend to think that the CMO is, I don't want to say more important, but I just think it's more important, because it's fundamentally the marketing team's job to find the channels. Sales team has one channel typically, which is hire more salespeople. And hopefully that works, and oftentimes that's necessary. But there's probably other ways to reach your customers, and the go-to-market organization needs to be pretty rigorous and obsessive about uncovering, okay, these are our choices. We've got 5 different places we can place bets, and this is the degree of confidence and probability that we have against each of those channels. And that's what that's what investability means. Okay, I'm going to give you $10 million. Do you know what to do with it besides hire more people in every direction?
Ryan Milligan is our VP of Sales and Operations, by the way, for those that aren't informed. And Sam, you're right. We are talking about similar themes. I think the role of the CEO, we've just already touched on ensuring you align to that vision and mission. And the second part of it is hire fantastic people and let them do their thing. Let them test, experiment, fail, do it over again. Test, experiment, fail, and let them build process as your team scales. And of course, the third thing that we all know, Sam, Asad, what's the third thing CEOs don't run out of money?
Never run out of money.
Never run out of money.
I think the CMO comment is interesting. I guess it's probably the role, at least in the world of go-to-market, where there's this huge gap between the need for truly elite CMOs and the supply of them. It's the common complaint that you hear from founders is like, I can't find amazing people. Now, there are amazing people out there and they're game changers when they land up in the organization, but there's not a lot of them out there compared to the need for them. I think experimentation, obviously CMOs will do a lot of top of the funnel for new channels, but I think it is a truly aligned effort because a CMO might activate some top of the funnel interest, but then the other side of the equation is, can we take that and close it? And are we handling it well enough to be confident that if we're not closing these at the right clip, it's not for us having not done a good job on those deals. It's because those deals are not closable for some reason, or they don't renew properly for some reason. So I think this is where like that go-to-market alignment becomes really important, where you need these teams to be working in sync, but they rarely do. And that's the job of a CEO, is to hire people that can actually complement each other and get along and work well with each other. There is a vibe aspect to a CEO's job, is to hire people that can have a good vibe amongst themselves and can work well with each other. And we always disregard that because we're so maniacally focused on these specific skills that we're looking for, which are important, but there is this other element that gets disregarded. The go-to-market fit thing, let me ask you a question, Sam. I think about this one a bit. Is go-to-market fit a stage after product market fit, or is it just a component of product market fit?
I would say it's, again, we're not Jesus, Muhammad, and, I don't know, the Easter Bunny aren't sitting there weighing in on, these are not canonical terms that have gone back centuries. These are things that we made up, in the last 15 years. But I would say that go-to-market fit is different than product market fit because here's what I'm thinking as we're talking. What I'm thinking about is the difference between getting to 20 million or 30 million is that my instinct is that you can ride one really good motion to 20 or 30 million, typically, if you have, with one product, right? And the challenge getting to 100 million or to 300 million is that most of the time you can't rely on one motion or one product. And the reason that we need experienced people from 30 or 40 to 100 and beyond is because you need the muscle memory of, this is when we layered in new products, and this is when we layered in new motions, and this is when we layered in new markets. And all of those things in combination are very tricky to understand exactly what's the moment that we need new products versus what's the moment that we need to expand into new geographies or new ICP versus we need actually just new channels to penetrate with our existing products. And for me, when I think about go-to-market fit, I'm thinking about scalability and investability. And when I think about product market fit, I'm thinking about renewability more than anything else. That's, again, I've had conversations with people that said, we figured it out. We've got product market fit. We made 20 sales. I said, well, when those 20 sales renew, that's when you have product market fit. Right now you have market fit, which means a bunch of people agree that there's a problem and they're intrigued by your claim that you can solve that problem for them. And so I think that they're different things.
Sam, I'll assume that I was the Easter bunny in that little triumvirate that you had. I'm surprised you didn't say leprechaun
against me.
Was there no leprechaun? You could have just said leprechaun.
I'm just saying, like, nobody, no God-like figure is decreeing that product market fit, go to market fit, or even terms that human society needs to abide by. It's just within our little corner of the world.
I think this is the interesting part, that it's like, because it's not written in stone,
we get to make it up.
We get to also debate about it and question some of the beliefs, right? That is this the right way to think about it? The more I think about product market fit, I think of it as, even if you have $1 million in revenue and it renews, your first $1 million comes from early adopters. And so to me, that's like, is that really product market fit? It's probably early signals of it. It's some product market fit, but I think the mistake founders make is they stop obsessing about it. So I think of a founder CEO's job as being 3 things: product market fit, capital allocation, and building and enabling a great team. And I think product market fit stays as like a core concern for a very long time, because there can be levels of product market fit, and each level can have an RPM meter within it. Are we in gear 2 with a 7 out of 10? And what does that mean for us? What is that telling us in terms of things we need to think about, prioritize, problems we need to solve, etc.? And I'm not sure about this, but the more I think about it, I tend to feel that go-to-market fit is kind of a component of product market fit. It's like, for ultimate product market fit, you have to be able to sell this in a way that is profitable at the unit economics level and is repeatable, predictable, and scalable. That's the sign that you have amazing product market fit. But this is a work in progress.
Are you coming to GTM 2024 in Austin, October 14th through 16th? Hope the answer is yes. My name is Katie Ivey, and I'm the CRO at Walnut, and I have the privilege of speaking at GTM 2024. In my session, I'll be diving into all things product-led sales, more specifically how to supercharge your PLS motion through interactive demos. If you're looking for more ways to infuse your product into your entire go-to-market motion, if you're looking for better ways to drive efficiency and improve close rates, or maybe more importantly, if you're on a mission to make your entire end-to-end customer journey more buyer-centric, as in give your buyers more of what they want, then this session is for you. So don't wait. Secure your tickets before they sell out at joinpavilion.com/GTM 2024. And as a thank you for being a Topline listener, you'll receive an extra 15% off your ticket with the code Topline. Hope to see you in Austin.
Let's talk a bit about some interesting research that PitchBook sent my way. So they sent me this report that is called the Q3 2024 Quantitative Perspectives U.S. Market Insights Report. Real catchy title there. But the report's fascinating. So it has some data comparing asset classes over the last many years. Venture capital was the worst performing asset class in 2022 and 2023, but it was also either number 1 or number 2 in 2014, 2015, 2016, 2018, 2019, 2020, and 2021. Private equity and private equity growth and private equity buyout, which are 2 different asset classes, but are kind of the same umbrella. They were either number 1 or number 2 in 2013, 14, 15, 16, 17, 18, 19, 20, 21, 22, 21, and then 23. So then what they've done is they've said, if we were to have invested $100 in Q1 2007 into one of these asset classes, how does it perform? Which one does the best? And so PE growth is number 1. That $100 would be worth $924 for you today. Buyout is number 2, which would have been $894. Not bad, right? Not bad at all. Venture capital is number 5. And it would have been $611.
Behind
Still
what? So number 5, what was 4 and 3?
Since you are asking, number 3 was secondaries. Number 4 was FOF. I don't know what FOF is.
Fund of funds.
Fund of funds. Look at you, Mr.
But is there
Finance.
what about public equities? What about buying Vanguard?
Yeah, I was going to say public markets is 7%.
They're looking at private stuff, guys. Private markets.
But what was the yearly rate of return? Because the public is 7% year over year since that time.
this would be a lot more than that, right? Like if $100 is $925.
Yeah, but that's over that time since 2007. But what was it year over year?
Do some ChatGPT stuff on your end, find out.
Asad is tired of all
financial wizard over here. But private markets it's just interesting data in terms of how these various asset classes perform. The question that came to my mind, but I think there's a few different angles that we can look at this data from, but the one that I was thinking about is that exits for tech companies happen in the form of you go public, very few do. But that's the ideal that I guess any venture funded company is hoping for. Others get acquired by strategics, so other venture funded businesses acquiring them. And then some go into this private equity land. And so should a founder in an ideal world know who their ideal exit is going to be to and optimize to get the best exit from that asset class? Because what will get you the best multiple from PE is very different to what gets you the best multiple from a strategic. And so everybody says, don't think about exit, just build, and then the exit will happen and companies are not sold and they're bought and all of that stuff's there. But this can be a thought, can't it, or should it not? AJ, how would you think about this?
Okay, I'm going to answer that question, but I did ask ChatGPT. So, given an average annual return of 9%, a $100 investment in 2007 would have grown to approximately $367 today. That's based on the S&P 500.
I told you this is better. At least I knew that. I was like, directionally, this is better.
To answer your question, no. The founders should not be strategically thinking about what their exit's going to look like, because that's focusing on the wrong thing.
Is it though? Tell me why.
I mean, it's one of the things that's a consideration, but it certainly shouldn't be the sole focus, because you're not putting all your eggs.
But should you think about it?
Founders are constantly thinking about wealth creation and what's going to get us the best return. I mean, if you're a founder CEO, you are a fiduciary responsibly for the outcome of the organization, and whatever that outcome looks like in whatever meaningful way should always be top of mind. But should that be hinged around a strategic? Should that be hinged on going public? Should that be hinged around whatever? I mean, I've been in a company where the CEO stood on stage in 2007 and said, "We are going public next year." And guess what? We didn't go public next year. In fact, that company didn't go public for another 10 years, a decade after. And by the way,
they went private, right?
They went public, and then they were taken private by a PE. But they went public for, I think the initial public offering was $500 million off of $225 in revenue. At that time. Trendkite
of revenue.
Trendkite was a tenth of that revenue, and we sold for half of the amount. So in less than a quarter of the time. So the return on investment was, you can do the math.
Honestly, I think now that the more I look into this stuff, because of Topline, one of the things I'm thinking is that you just have to wait for the frothy market to come. It will come. There will be a frothy moment that will come in your lifetime. And Bill really said, that's when you make the money, right? That's when you have to be in a selling mode. So you just prepare, and then the frothiness comes and you sell for craziness and you get out. Like, that seems to be the way that the best outcomes have happened for people. They've waited for the right market rather than thinking about the right buyer.
Buy low, sell high. It's crazy, because we're sitting here talking about, yes, venture and PE even have been, well, not as much PE, but venture has been depressed over the last couple of years. ZERP, or the cost of acquiring new revenue. And David Spitz wrote a great post about this today. We can talk about that. But it's crazy to me, because everyone feels so chaotic right now from this is my perspective and my point of view, that founders or boards or investors are it's just very and I'm just what I know the market is a big part of this. Why in the world would any founder be out there unless you absolutely have to? And I guess there's lots and lots of founders out there that are looking for places to land the plane because of capital and not having it. But at the same time, if you're in a position to really figure it out and make your dollars stretch, then go do that. Go do that. If you don't feel like you have clear product market fit right now and something that you should be obsessed about, And I feel like, by the way, I'm writing this week's Topline newsletter, and you guys are just giving away all my secrets in my Topline newsletter. So I'm slightly disappointed in that, but it's
How
okay.
did you enjoy writing it, by the way? Like the idea of writing long form, was it enjoyable?
I loved it. I had a great time. Really enjoyed it. But we won't go down this rabbit hole too long. But I really, really enjoyed revisiting it and coming back to it and thinking about stories on my run. Like, oh, I want to add this. But there was a level of like, it needs to both be long form, but also be simple that I just really, really enjoy today. And so
it's a really interesting exercise.
Yeah, it's great. It was great exercise. So thank you for allowing me. But back to the point, the question is like, we have a strategic alliance with a couple of different companies. Our most public company that we have an alliance with is HubSpot. And I get asked all the time of like, from an acquisition standpoint, and that got ramped up when our competitor got bought by Salesforce. And I don't think about it that way. I think about the strategic positioning and the strategic value our organization can bring to a HubSpot. And if it ever does make sense to have that conversation, then it will present itself. But that's not my end goal, and that's not what I'm driving for.
Sam, you're in the world of enabling executives to be effective, right? That's kind of the essence of Pavilion, is like you come here and we equip you to be a truly effective leader in the world. And that's a great mission to have. Do you feel that leaders and even maybe people at the associate level, that they understand the types of businesses that are out there? Like sometimes I talk to a person that's transitioning from leading a venture funded go-to-market team to a PE funded, PE owned business. And I get worried because I realize that they don't know what they've gotten themselves into. It's not bad. It's just very different. It's a very different type of business that you're getting yourself into. PE firms own the majority or all of the business. They're very deeply involved, and what they're optimizing for from a unit economics perspective is very different than what a venture funded business is optimizing for. Do you feel that there's a gap in our ecosystem in terms of understanding the types of asset classes and the various nuances of companies at different stages in their life cycle within these asset classes?
Yes.
Would you do a
feel like
course
there's
on
a
this?
gap across the first class. When I designed CRO school, the first module that I wanted to teach was developing a theory of enterprise value. That's what it's called. Now it ends up being really a dissertation on unit economics primarily. But the reason that I call it developing a theory of enterprise value is because my experience is that so many fairly experienced commercial leaders, they don't even know what makes a company valuable. And I think this sort of speaks to, your earlier question to AJ, which is, should we optimize for growth equity? Should we optimize for venture? Should we optimize for an IPO? And my instinct traditionally has been, no, you don't optimize for those things. You have to listen to your customer. But it is incumbent upon you to understand how it all works, exactly to the point of your question, Asad. And it's incumbent upon you to figure out whether a decision that you're pursuing, as long as you're intentional about it. One of the things that we're doing at Pavilion on our corporate side is, we have this learning business, and we are to teach people exactly what we're talking about. And I don't think it's a seat-based business at this point. I think it's a usage-based business. I think that you don't necessarily need to join a membership community to take CRO school. I think if you want to take CRO school, you can take CRO school. If you want to join the community, you can. Now, I'm also aware that when I'm doing that, what I'm doing is adding complexity to my business. Now, I can do that if that's the right that's the right path for me. But I also have to understand that the more it's the heart, Shamath talks about this figure it out factor. And at a certain point, if a business is so complicated that you're trying to establish and draw all these probabilistic correlations, watch how when this happens, these three things happen. I'm pretty sure, meaning when somebody pays me this money for this membership, I tend to make money on schools, and I tend to make money selling tickets to events, and I tend to make money on sponsorships. That's all well and good, but that is complicated. And I should be aware that when I'm introducing new revenue streams, the complexity itself is a drag presents a drag coefficient on the overall enterprise value. And that simplicity of understanding, which is exactly why oftentimes there's a valuation unlock that happens when big companies are split up, because it's easier to understand where the value is being created within each specific business unit. And then the investors themselves can diversify, as opposed to the holding company or the large conglomerate like a Google or a Berkshire Hathaway or whatever doing the aggregation on their behalf. So all of that is to say that I don't think it necessarily means that you need to change your strategy to pursue a specific outcome, but you should be aware of how your decisions might impact your specific outcome and go into it with eyes wide open. And I do think, to your point, Asad, that a lot of people don't understand the differences at all. They don't understand, again, like I said, where it starts is they don't actually understand how how value is created.
Yeah.
They haven't taken like a basic, you don't even have to take a class. You have to think about how is value created? How is value taxed? How do markets work? And then from there, what are the incentives of these different types of investors, and how does that relate to the operating strategy? And again, to your point, it's because venture is about power law outcomes, pursuing big opportunities, and private equity is about pursuing doubles and triples, but understanding that if you run the business super well, which oftentimes is in conflict with the wild-eyed optimism of a venture capitalist or the humanity of an early founder that has compassion in their hearts, and the private equity firm has compassion only for EBITDA, oftentimes there's conflict there that people aren't appreciative or aware of enough. And again, it relates to a lack of understanding about the types of investors, but where it comes down to me is that it relates to a lack of understanding of how is money made. And it's too many people that get into executive positions, and really it's because, they worked at Salesforce, they worked at some big companies, but they never had to stop and think, besides hiring more AEs against a target, why is this valuable? What does value even mean? So
I had a very huge conversation with an executive from Google who's looking to leave. And I was like, what are you thinking about as a next step? And they're like, thinking of joining a really early stage startup. I was like, great. Well, how big? What stage? 300-400 million in revenue, 200-300, maybe something like that. It's like, it's just so interesting when you talk to people and that they haven't really grasped the various games that are being played out there. And the thing I see all the time is somebody moving from one type of company to the other. They get their offer, and the offer has an equity component. But how that works is so different if you're publicly traded versus PE owned versus venture. The probability of upside is very different. The type of allocation you'll get is very different. I've learned, so our business is now probably 60-40 in favor of PE, which is just really interesting. It was never like that. But on average, I think PE CROs and VPs of sales make more money. I think more of them actualize the upside that they're being offered in the form of equity than venture CROs. Now, the ones that join the right company, the rocket ship at the right time, will make a lot more money on the venture side. But those are just few and far between outcomes.
That makes sense when you compare it to the PitchBook's data that you literally just said. Like I would assume that it would follow it. But that's the last couple of years where we all know sales leaders and CROs that made a ton of money 2010 to 2020. Yeah. So that feels like it has a recency bias towards it today.
I think if you take out these unique moments in time and you look at it across a much longer time frame, PE just rarely loses money. It's not common for them to burn an investment. It happens, but it's not common. Like, we're working with a firm that has like 10 billion in assets, I think a couple of 100 plus in acquisitions. I think maybe one or two is where they've lost money. in that portfolio. And so you end up making, you make your money on the PE
Well, I
side.
think that's why Pluralsight was so surprising, because you
It
had
was so surprising.
Vista coming
Whereas
out
it's
and
not
saying we're writing to
surprising when a
zero.
venture-funded business falls apart, right? So it's just different games, and you kind of need to know which game you're going into play. Well, the last question I had was a quick one. I've been looking at Snowflake a lot. I think Snowflake's a very interesting business. It was the largest IPO ever and got a $70 billion valuation when that happened. It's worth $39.5 billion right now. NRR, I think they have the record for the highest ever at 173%. It's 128% now. Buffett broke his rule of never investing in an IPO and invested in the IPO, didn't make any money, recently divested his investment. Franz Slootman was the CEO. I think he has a record for within a certain time frame for having created the most enterprise value in the public markets, but he is no longer the CEO. He's handed the reins over to a chap called Sridhar. And this guy was the SVP, was an SVP at Google, and then had a startup, didn't go well. It was acqui-hired by Snowflake, and then he's now the CEO. He's been having a real tough time. When they announced him as CEO, Frank took him on Kramer's show on CNBC and was like, I have chosen this. This guy is great. Immediately, the stock went down 20%. And so we spoke about stocks going up by 20% when the Starbucks guy went. This guy led to a 20% drop in the stock. And since then, they've just been struggle city in the public markets. And I think part of it is when you contrast him, who is very soft-spoken and not charismatic, but I'm sure technically very strong. And when you talk to people about his leadership, they say great things about him. And then he's a killer. He's an undeniable killer. He had a 10,000 person org at Google, but he's not that charismatic. And you're replacing Franz Slootman, who's Mr. Charisma, right? Amp it up, just intense as hell. Sam, maybe from your time at GLG, but other times as well, have you ever seen a transition work well when the person replacing a charismatic leader wasn't charismatic, hence you always have to get charisma in the next person? Or is there a way to solve this problem that's different?
Well, let me ask you a question. Do you think Satya's charismatic?
Yeah.
Do you think
I think he's quirky. He's quirky and nerdy.
In hindsight, because Microsoft's done so well, is there?
Yeah, probably.
Probably work there.
I think also he was replacing Steve Ballmer, who people had started thinking was insane, right? So they wanted a more subdued.
Argue Ballmer's charisma.
Ballmer was
Sundar charismatic.
Is Tim Cook charismatic?
No,
I don't think so.
No.
But I think until probably the last year or two, I think it's been an incredibly successful handover.
Yeah, you're right. Very good point.
So who's the CEO of Amazon now? Is it Andy
Jassy?
Andy's charismatic, isn't he? Andy, I mean, he ran AWS.
I'm only saying that, listen, anytime you move from founder. Fundamentally, what I think is there's one Jeff Bezos in the world, there's one Steve Jobs,
one AJ Bruno, one Sam Jacobs.
Fine, there's only one AJ Bruno, that's for sure. And I think when you have those people, inevitably, and you switch to somebody else, 90% of the time, it's really just like a half-life of how long can they retain some level of enterprise value before the air starts to come out of the balloon. I think Tim Cook has done an incredible job because he has brought very few, I guess the Vision Pro is the main new product, right? But really up until, I think replacement cycles on iPhones have really extended recently, but until the last couple of years, Apple's been on an absolute tear. And it's really just been because Tim Cook's an incredible operator for the most part and an incredible steward of Steve's vision. So
they also introduced a services business that was recurring revenue. That's massive. They introduced the AirPods, but there wasn't massive innovation. He came from an ops background and he kind of did what you would expect a really good ops leader to do.
Yeah, really good ops leader. Really good ops. Yeah, exactly.
Really
so, if I can think of what's a counterexample, I would say Bob Iger replacing, Eisner. And I don't know if it was direct succession. If it was, it's the greatest 1-2 in media history.
I didn't know that.
But,
in media history, you said, right?
I would say, I mean, I just don't know enough. I just know that Bob Iger has had one of the most incredible runs, and because you mentioned Bob Chapek in your in your note. And my point is, Bob's obviously he's not Walt Disney, but he's also not the person that put Disney on the map in the modern era, because that was Michael Eisner. But the point is, I just think it's a crapshoot. I think it's a crapshoot. That's what I think. I think if Snowflake was doing better, we would call this guy Sridhar super charismatic.
Yeah.
And because they're not, we're saying that he's no fun. And, he's following all the wrong memes on TikTok. And,
I mean, it's also been like 2 months, right? I mean,
hasn't been a long time.
No. But I do think, Asad, you had sent a post. I don't remember if he wrote it, but it was like, here are the changes I'm going to make. And it was like, I'm going to make sure I'm in the office. And our preview, but was that from him?
That was him. He did a piece with the information. And what I found a little bit interesting is I heard an interview of his yesterday as well. He speaks well of Franz Slootman, but then every now and then he kind of differentiates why he's a bit of a better leader for Snowflake today. And maybe that's his job, right? He has to prove that I'm doing things better than they were being done before, because you lose enterprise value today because of mistakes that were made years ago.
So is that a message for the public market or for the internal team?
I think so. I think he's saying, listen, guys, like I just got in. The fact that we're in this position meant that years ago, there were decisions that should have been made that were not made. I think that's a really fair point. They should have had a platform play. They didn't have a platform play. They should be better prepared for AI. They were not better prepared for AI. Like, I think that's a really fair point. So he's trying to say, I am here now. This is what I'm doing. This is why this sets us up for the future. And it won't paint the old Snowflake in amazing light. But that's okay, because their performance isn't amazing right now. So obviously some mistakes happen. I think initially it was annoying to read, but I think it's a fair thing to do.
I think when you inherit an incredible run, last 2 points. First of all, it's like Frank Slootman, we know first of all, he's had an incredible career, but certainly Snowflake came to prominence as a ZERP era, COVID era, technology business. So my point only is that it's really hard to figure out what is directly attributable to Frank Slootman, what's attributable to the environment, what's attributable to the market, what's attributable to luck, as always with all things. And the second thing is, once you inherit, by definition, the Steve Jobs, Tim Cook transition, Tim Cook's going to feel just an incredible amount of responsibility to be a steward of the Jobs vision. But Steve Jobs didn't feel any responsibility at all to be a steward of anybody's vision except his own. And I think if you're looking for alpha, it's by definition going to include risk. Think about somebody that says, this is my handpicked successor. Okay. What is the nature of that relationship going to be? Probably, well, this is a person that's been appropriately deferential to me over the course of my leadership. And I really like them as a consequence, because I find that they agree with me often. And I feel like their vision of the future aligns with mine. And that person's probably been trained to align their vision to their bosses. But by definition, the number two person is going to be the executor relative to the visionary of the number one person. So if you want to keep,
that's a really good point. Like Andy Jassy to Bezos.
Yeah, it's like, so if you want alpha, you want to invent, now Amazon would say our process generates alpha because our process is what built Alexa. Our process is what built AWS. Maybe so. We'll see. I don't think so, given
But that's
how
not
many
true
decisions.
for Apple. 100%
Well,
not true
also
for
Jeff
Apple.
Bezos was involved in so many damn decisions that you just can't say that. He was so micromanaging on all of the big initiatives that it just doesn't. But my point is, listen, if you want alpha after an incredible run by a guy like Frank Slootman, you're going to have to gamble. It's not going to be who Frank thinks is the next great person. It's going to be somebody that's like, we're doing something. We're going to, we're building cars. We're doing something crazy. We're going to do something completely different. Otherwise, by definition, the person will be a steward of the predecessor's vision. I don't understand how it's going to end up any other way.
What an interesting topic.
We should. I disagree with you, by the way, on the Bezos point of being him a full micromanager.
I love that. I want to be wrong. I like Amazon.
We're not going to have time to debate that one, but I think I've never worked for the guy. I've only read about him. I think that it's misunderstood that he was maniacal about the process of what Amazon was going to be built, and if you didn't follow that process, then you were you were out.
My experience, I hear you completely. And again, I think like if any company has a chance, it is Amazon. But I still think, reflecting on it as I read, working backwards, thanks to you, is that like it's really just like, is it going to be 90% of Jeff Bezos or is it going to be 50%? And it's like, well, it's going to be 90%. It's going to be really, really good. Whereas sometimes you hand it off and it falls completely off the rails.
Yeah.
And
I think I'm just making the distinction. I'm just making the
special.
He was sure.
Your distinction is the process versus the leader.
This distinction is between like a Steve Jobs, who every single marketing piece that went out the door had like maniacally had to go through Steve on that one thing. And it was very marketing. And yeah, sure, he's a product guy too in design. But I think the rest of the company kind of like was built around that. Similar with Facebook and Zuck was product, right? The rest, the commercialization was built around it. Bezos, I think his product was the process of the company, which is just so unique in how companies get built. But
I think Zuck's transformation, like this new Zuck, is fascinating. You guys should follow like how he is evolving right now. I think it's a masterclass. Like it's a real masterclass.
So cool. He's actually
his letter to this congressman that went out yesterday. I'll send it to you guys. It's fascinating.
Well, shout outs, Wiles.
Yeah, let's do it.
I'm off if that's okay.
Okay. Eat a beaver.
So last week we had a company offsite. I mentioned it on Topline, and it was phenomenal. I've given lots of accolades and shout outs to a lot of people on my management team, including Ryan Milligan, and Graham's name has come up. My co-founder is Cole and Eric. But the person that I haven't always talked about that kind of works in the background is Carrie Carroll, our head of people. And Carrie, I've worked with for 10 plus years over multiple companies, and she has flourished in so many different ways, but she ran an outstanding offsite. And just don't take my word for it. The field trip, which is what it was called, it was coined, it was in Philadelphia. So PHIEL trip feedback was so good that it would even make Asad blush, our NPS. And I'm doing something, I'm sharing my screen right now.
Wow.
So we had an NPS of 86 from it. And you can see great. There's AJ talk, but I didn't write that one. I promise you I didn't write that one. But I just found what's really great about this is all of these workshops and sessions, there's high fidelity on what sessions did you find the most valuable. And somewhat interestingly, there's fidelity around those same sessions and what could be improved. So I think that was really great to see something like that. And Carrie absolutely knocked it out of the park. So shout out to Carrie. So many great things that came out of it. If you want to run a masterclass on a great offsite, talk to my head of people because she did it last week.
That's good feedback. That was great. Congratulations. And you worked on this one a lot. Like even just the deck. Yeah,
I focused on my presentation and my deck a lot. I probably put 20 plus hours into it, which is a lot for me. But I heard really good feedback on how to think about public speaking in general. And the three of us, we're all different and we're introverted and extroverted in some ways. I'd say I'm probably the most extroverted of the three of us. But the thing I heard is that think about a message that you have to get out. It's not about you or it's not about the audience. It's about that message, and it comes from the heart. And you just have to tell other people that thing. It's the most important thing. And that just changes the game on how public speaking should be done. So I just got really passionate about the subject matter that I was talking about, and the conversation was great.
Very cool. Very cool. I'll go next. I read this blog post over the weekend. So I really like following. I think Scott Galloway is somebody that we should cherish. I think he's super sharp. Really, I find him fascinating. I also think I find him inspiring because he seems to be a person who has created a lot of leverage for himself. He's financially very secure, and that gives him a lot of confidence to share his true self, or as close to your true self as you can potentially share with a large market. He does, and I think that's fascinating to see. And so I really like his blog. It has the best name, No Mercy, No Malice. What a name for a blog. And the one that I think most people have heard of is when he tore apart WeWork's S1. But there was a guest post by Josh Brown, who comes on CNBC a lot. And the guest post was basically around this idea of how being pessimistic or optimistic is a choice. And being pessimistic is something that it sounds intellectually really smart. It really does. Like when you hear pessimist, like explain why everything's gone to hell and everything's been, yeah, it sounds amazing. And sometimes the optimist sounds ridiculous. But I think no one changed the world for the better by being an eternal pessimist. The optimists change the world. They're the ones that create value. And one of the things I'm learning is that we don't spend enough time qualifying if a person we're hiring is optimistic or pessimistic. I think that's a really important thing to understand. You need some realists, maybe your CFO, but you need a bunch of optimists around you. Otherwise, the vibe of creating value out of nothing, the vibe of going down this hard path is going to be really unproductive. And so, I think people should go read the blog because I think it was really well written. B, I think we should all work on figuring out how can we be more optimistic if we are operators and founders and CEOs? And I think it is a muscle that you can develop because there's some days when I wake up and I feel very burnt out and I'm very pessimistic. And some days when I'm rested and I'm very optimistic. So I do think you can nurture this. And C, I think we should be very careful hiring for our teams and make sure that we have overrepresentation of optimists, but a few realists as well. So that was my shout out. No mercy, no malice. Oof, what a name.
I, about a week and a half ago, the very first person I ever hired at Pavilion said goodbye. And Jusim, our VP of people, I left the company after 6 amazing years of working together, and started off as our head of operations. Ann and I built all of the first automations in HubSpot and brought popcorn with Revenue Collective stickers on it to the Christmas party at the Freehand Hotel that Manny Medina was at. Manny sent me an email on the flight back. This was December 2018 saying, I really think you need to work on this full time. And the next week I was fired from BehaveVox and didn't have a choice. But Ann has been there the entire time.
What a story.
And then she moved from operations to HR and people, and she built out our compensation philosophy and our professional development paths, and she set up our 401k program. So just in general, she's just been and she's also personally worked with me through a lot of personal stuff that's happened over the years at Pavilion. So I want to give her a shout out and say thank you, Anne. Hope you're listening. She's at the beach right now. And I hope that wherever she is, she's eating some ice cream with Benny and Harvey and having a smile. And then I also just want to give a shout out to the Pavilion HQ organization. It's obviously always really nice when you go on vacation and you flip open your various dashboards and you power up your cockpit and you look at it and everything's a green light go. And, it's been a really hard couple of years to get to this point where we're beating our plan, where NPS is moving in the right direction, retention's moving in the right direction, we're beating our cash flow forecast, ARR is going up. It just feels really good, and it feels like we've got some momentum heading into GTM in just over a month in Austin, Texas. So shout out to the entire team, especially the community team, Liz, Tanisha, Colin Campbell. Thanks a lot for all your hard work on what's been a really strong August so far.
Shout out to them. There we go.
Thanks, everyone. Talk to you soon on Thursday for Topline Hotline.
Bye, everyone.
Bye, everyone. Bye. This episode was brought to you by AirCall, the business communications intelligence platform. Deliver a better experience for your customers and your teams at AirCall. That's AIRCALL.io. Save time, save money, and improve performance with a single communications platform.
Thanks for listening to Topline. New episodes come out every Sunday. If you like what you heard today, subscribe so you never miss an episode, leave a 5-star review, and share it with your friends. Don't forget to join our Topline Slack channel to connect with us and discuss the topics we cover with other listeners. Click the link in the show notes. Lastly, if you're interested in joining Pavilion, you can learn more about membership at joinpavilion.com/membership. Thanks again for listening.